So, why are financial statements important? Financial statements are at the core of any financial activity or businesses. They contain reports about business financial results, financial position, and cash flows. Financial statements are useful to understand the company's ability to generate cash and the uses of that cash. They are useful to understand whether a business can repay its debts. They can also use to track profitability and derive financial ratios to interpret the performance of the business. They can also help us to investigate the financial transactions of that company. The main reports included in financial statements are income statement, balance sheet, and cash flow statement. All of these reports are produced annually, but in many instances more frequently. The income statement focuses on the company's revenues and expenses and shows the company's net profit for the period. The balance sheet provides a view of the assets and liabilities of the firm at a fixed point in time, normally at the end of the reporting period. Finally, the cash flow statement measures how well a company generates cash and the uses to which that cash is applied. For example, paying its debts, funding its operations and investments, or returning cash to shareholders. Financial statements are used by shareholders, investors, and financial analysts to evaluate the performance of a company and to make predictions about its future performance and earning potential. All audited financial statements are produced to internationally recognized standards. These accounting frameworks make comparison between companies possible. In a company's annual report, you will typically find an auditor's report. So that will be confirming the accuracy of the numbers so they can give a true and fair view. And also financial statements. Thirdly, notes to the financial statements which support the detail of the numbers. And finally, you will find management discussions and analysis, which provides the context for the financial information. In the US, the Securities and Exchange Commission, so SEC, require listed companies to produce regular filings. For example, 10K, that's the annual report with a comprehensive overview of the business. And then 10Q, that's quarterly report that provides key financial information every 3 months. 8K, that's any major events which may impact the financial position of the company. And finally, Form 3, 4, and 5 that reflects changes in the ownership of stock by directors, officers, and major stockholders. In the UK, the London Stock Exchange (LSE) requires a similar but not exactly the same level of disclosure. When you understand how to interpret financial statements, you can start to extract value from the information provided. For example, profitability. You can read financial statements to interpret profitability, the viability of the company and its competitive position. And also liquidity. Does the company have the assets to meet its liabilities? And finally, cash flow. Profit doesn't equal to cash. Is the company generating cash? And if so, how is that applying that cash to ensure the secure and profitable future of the business? You can discover how to calculate and interpret this analysis, and you don't need to be an accountant or a financial analyst, but it will give you a solid grounding in the understanding of financial statements. Once you learn to read and interpret financial statements, you will have a financial skill which can be applied to any company in any industry, even though each industry sector is very, very different. You'll come to realize that all financial statements are open to interpretation. They are like a coded message, which is for you to decode. But the information are all there if you know how to read it. Thanks for watching, and I will see you in my next session.